think the market is too expensive right now? Is probably the toughest question I'm going to ask you today.
It is a tough question, Matt. And the reason I think it's tough is because there's two elements when you're valuing the market, when you're valuing individual stocks. On one hand, you have the pure math of it, right? That's very objective. And so we're going to explain what the price to earnings metric is, what the price to sales metric is. These are easily calculated. They're simple math, and it's very objective. And yet they're kind of useless because there's this whole other element that goes into it that is context. And the context is very subjective, but without the appropriate context, you really can't understand the valuation. So there's the element of objectivity and subjectivity playing together that makes it a very complicated question.
So one thing that I hear all too much, especially on Twitter from a lot of people, is valuation doesn't matter when you're talking about growth stocks. I usually end the conversation there. I consider myself to be probably the most value-oriented investor at the Fool. I'm definitely a value investor at heart, but the definition of valuation is different depending on what kind of stocks you're talking about. So with my investment style, I definitely consider valuation. Even the most growthy stocks, their goal of a growth stock is to eventually get to a point where you're making profits and you can be valued by traditional metrics. Apple started out as a money losing growth stock. Now you can actually make the argument that it's somewhat of a value stock based on traditional metrics. So valuation absolutely matters. No one's going to buy a growth company that with a market cap of $1 trillion if there's no reason it could ever justify it. So how does valuation come into play in your investing style?
Matt, I think I'm kind of similar to you in this aspect of, valuation does matter. It's constantly trying to find that appropriate context, like we were talking about. So I'm going to share my screen real fast, if I can remember how. There it is. So this is some research here from Yardeni Research, right? And so this is showing the PE ratio of the S&P 500. And so I just wanted to put this up here just so people can get a glimpse. This is going all the way back to 1989. The blue line is trailing. The red line is forward. We're going to explain what these mean, but for now, just suffice it to say that the higher the line, the more expensive, right, by a valuation metric. And you see this big spike here in the blue line. It's also up on the red line. So if you're saying, yeah, that by a PE ratio, the market is historically expensive. This is the price to sales ratio for the S&P 500. See it over here in 2006, way down under 1.5. We see it right now, almost double that at 2.8. And so on one hand, that would say that we are overvalued, but there's context. So the top 5 stocks make up a disproportionate size of the S&P 500, more than they ever have. That plays into it. Those are some quality businesses that deserve a higher valuation, so they're dragging the whole market up. It plays a part of my investing style, but it's not the whole thing. So constantly trying to find that context. And so I'll throw one example out there, Skills. When that stock was up at 30, I really liked the business a lot, but to me, I forget what the market cap was at that time, but it looked very expensive based on where they were in their journey. When it got down to below 15, then it started to pique my interest based on the context, based on what their valuation metric was and their context, their growth rate and all that, their opportunities. So yeah, I bought Skills down there. I didn't want to buy it up there. It seemed like it was ahead of itself.
So according to your chart, this is the most expensive market we've seen since about the 2000, the dot-com bubble. So, and I don't even really count that because that was a very sector specific bubble. Most of the stock market wasn't trading at the valuations we're seeing today. But another thing I want to point out is one big difference between this expensive market and previous ones: interest rates. Think of the interest rate environment today. I won't want to get into the mathematics of how interest rates affect the stock market. We don't have 2 hours for me to go on drone on about that. We have a former math professor talking about the interest rates. But interest rates are historically low right now. And this means that investors cannot get a lot for risk-free assets. I don't know about you. I have no desire to own a 10-year treasury right now.
No, absolutely not.
Or put money in a savings account for that matter.
Yeah, you're not even keeping up with the rate of inflation with those. So
right. So the risk premium that has to be tacked onto stocks for the return potential is much greater than it was in either of those previous market booms that we saw. So with that, I don't want to drone on too far about interest rates, but that is one big difference in this market that's worth pointing out. And as John mentioned, we have to think about different stocks differently. I already mentioned Apple. The way I value Apple is different from the way I value my bank stocks. I'm a big bank stock investor, like Bank of America is one of my big positions. And that's very different from the way I value growth stocks. Pinterest is my second biggest stock holding. And if you try to use traditional valuation metrics, I would have to be crazy to invest in it. But you have to think of it in a different context.